Hey everyone, me Kevin here. A lot of folks wondering, why did the market feel like it trended down into the close today? Was there something in particular that market started to digest? And the answer to that was yes, quite possibly. Look, obviously we had a fantastic CPI report, PPI report, and import-export prices report. That would be Wednesday, Thursday, and this morning. But we also got consumer sentiment data. And today's consumer sentiment data was a little bit more excited than previously expected. Take a look at this. The survey for the University of Michigan was expecting a consumer sentiment read of 65.5. We actually got, and this would be up from the prior read of 64.4, but we actually got 72.6. So an explosion here in consumer sentiment, which is very good because to some extent it maybe gives you some hope that if consumers are spending happily and they're traveling more, then maybe we won't actually walk into a recession because consumers, again, making up around 70% of the economy could keep us out of a recession. The question is, are they going to have enough money to keep sustaining that to prevent us from going into a recession? And then what is that going to mean for inflation? And that's where Barclays this morning warned that we got to be careful. Even though this June CPI report was exciting, we're worried that the airline disinflation that we saw in this report and used car prices as well as lodging prices could potentially see a rebound. And I don't see any leading indicators of used car prices coming back up, but I totally agree that the next 2 months could be bumpy with inflation thanks to airlines, which will probably see more demand than any seasonal adjustments will cover us for, and lodging. We also saw current conditions. Look at how this expectation skyrocketed. This is your preliminary read for July. That's why right here it says July P. Preliminary for July. The final read will come out on the 28th, which is just a couple days after that expiration of the coupon code for the programs on Building Your Wealth. Remember, if you're a course member, you get a big discount for shadowing me when we explore to look for real estate. You get a day to travel with me. We'll look at real estate locally, just depends on what we're doing, and you get to come with us. It's fantastic. University of Michigan expectations were at 69.4. These are condition expectations. So you've got how are you feeling right now? How are business conditions right now and your financial conditions right now? What do you think about the future? All of these coming in very, very hot. And you actually see that you're getting a little bit of heat over here on the inflation expectations. And I think this is probably what helped drive the market down a little bit today, where folks started getting nervous again about the idea of, what if we're going to get that resurgence of inflation? And I have to say, it's a little exhausting. It's exactly what the bears are looking for and consistently trying to point to, just wait for the second wave of inflation and then we're going to have a double dip crash. No, it's very unlikely that we would have a double dip crash unless there was some black swan event or something that really led us back to a Paul Volckering level of fear, which we hadn't seen since really Jackson Hole, September of last year, and of course led to some big old tax loss harvesting going into the close of last year. I mean, look at this. These little expectation surveys that are so volatile are ultimately compared to charts like this. These charts are what we're told is reality. Of course, we know sometimes these numbers can seem rigged, but since markets move based on this data, let's just assume this is more accurate than people's expectations. So as you can see here, food inflation is making up a very small percentage of our inflation rate right now. Most of energy is actually leading to negative inflation, so deflation. We've got new and used vehicles have basically disappeared from contributing at all. It's actually a tiny little white sliver right there. Then you've got your core inflation line, which is actually this yellowish line right here, showing you that's still where you've got a little bit more inflation than the total set of inflation. And the big contributor to that is going to be the blue segment here, which would be your core services, which is where you're going to have all of your financial services, your travel services, so on. You know them by now. But the point is, look at the trend, folks. I mean, it's obvious. It's obvious. The peak is here. We're trending down. The peak is here on core services. And look at the delay in the peak, right? This is about a 6 to 7 month delay in where we actually saw the peak in overall inflation and the peak in core services inflation. And look at the trend, though. I mean, really, this trend If we were to draw somewhat of a line, maybe somewhere right here, yeah, you can't really see it. That's not even really a good one. But it's obvious that the trend is down. Here, let's just remove the image for a moment. There we go. If I told you this was the trend over a 6 to 10 month period of core inflation, or are we really going to be bearish that some expectations have ticked up a little bit in the recent survey data? No. Again, this data is very, very volatile, and what I like to do is compare it to what the bond market is responding to it. And we're seeing 10-year Treasury yields fall, but not only are we seeing those 10 years finally fall off that 4% we got, but look at the 5-year break-even here. Here's the 5-year break-even index. We're sitting at about 2.16. Before CPI, we were actually at that peak right there, which was about a 2.22. And we've come down. So the bond market is saying, whatever. Take your volatile consumer expectations for inflation and forget about them. We actually think we're still on this path of really a longer-term downtrend of inflation expectations. And again, to see cuts, we really need to bring this down to about 1.6 is likely. I think this is probably the tool the Fed is using pretty regularly. So not horribly concerned, although I do think markets can get a little nervous and start hedging a little bit. Saw almost a blow off the top on NVIDIA today. Pretty wild movements in the stock market. But let's take a look at another piece of inflation data. This is the rent of primary residence, 1-month change and 12-month change, and what we're expecting in terms of how it will show up for CPI. And so these are the projections we're looking at. We're just now starting to see the disinflationary process begin for rental inflation. That actually is really good because it gives us a tailwind. There's something that supports us of disinflation. That's what we want. We want more disinflation, and that is coming. Leading data for via Zillow, Redfin's data center, Apartment List, and CoreLogic. All of them are pointing to more rent disinflation rather than resurging inflation, which that would be a big problem. If rental inflation started trending up again, we didn't actually fulfill this dotted line, that would be a big problem. That would lead the Fed to really have to get more aggressive. If we jump into some of the core services that people are nervous about, you can even see, yes, health insurance is a little hot, along with medical services, excluding health insurance, but they're relatively stable. We lost some of that disinflation that we had at the end of last year, but we're stable. We're certainly not taking off on this medical services inflation, which is good to see as well. Here's another one to look at. These are really your inflation expectations charted over time. And you can see it's relatively a volatile survey. This is the Michigan survey charted over time, and it compares to what we started this video on. And look at just this overall downtrend we really have here. I mean, here's your ceiling on your 1-year expectations. Your 1-year expectations actually pretty darn low. Notice how they actually, just in the last few months, we had a little bit of an explosion over here, and it just shows you this volatileness. So you really have to look at the trend. Gas prices are the blue line, and those have actually somewhat solidified over here. And then you get your 5 to 10 year inflation expectations, which are here. But just look for a moment in the longer term here, how volatile this read is. And that's 1 year. Just this little section here is 1 year. So it's a lot of volatility over time. So this kind of nonsense is expected. It is worth noting, though, that level is slightly elevated from where we have been in the past. If we take this across, you can see it's certainly higher than where we were with expectations for 19, 17, 16, 15, 14, so on and so forth, right? The prior years. But it's not too dissimilar from what we saw when we really started printing money to get us out of the Great Recession. But I do expect that as more reports come in soft, this will slowly start showing a trend down, much like this downtrend you got here. But look how long it took to go from a 2013-ish start to really this low level over here. It took 6 years for that 5 to 10 year inflation expectation to come down and for you to really get that trend here. So these inflation expectations are going to be something that a lot of folks get nervous about, and I think you'll get some market volatility because of that. That's likely what we saw in the market today, but otherwise, has there been anything really bearish today that's maybe think, oh my gosh, it's time to flip? No, No, of course not. I'm obviously still cautious when it comes to, you don't want to go too heavy on margin or use margin at all. I'm not a big fan of that. It reverses the psychology of wanting to buy the dip because then you get nervous about, oh my gosh, what if you get margin? Margin's just bad. I would highly recommend staying away from it. But other than that, this gives you a breakdown of maybe why we had some volatility going into the close. Check out the programs on Building Your Wealth, link down below. Thank you so much for watching and subscribing. Share the video if you found it useful, and we'll see you in the next one. Goodbye.